To conclude our webinar, we're going to talk about exposure or risk mitigation. Again, the biggest issue that people seem to have with self-funded plans is their exposure from claims. Well, there's two stop-loss products that protect the employer from exposure. The first one is known as specific stop-loss insurance. And you'll typically see limits of $50,000 to $75,000 per employee. And the reason that you'll have specific stop loss is because one employee could have a catastrophic claim. So for instance, if John Smith has a terrible year and he has $1 million in claims, the employer is only responsible for $50,000 of his claims. Everything above that is covered by the insurance company. So that's known as specific stop loss. The other product is called aggregate stop loss, and that protects the employer if they have numerous employees with high claims. So for instance, with a 100-person group, you might have an aggregate stop loss limit of $1 million. So you could have 100 employees that each hit $10,000 in claims, and you've now met your aggregate stop loss limit. So you have individual protection on each particular employee, and that's called specific stop loss insurance, and then you have aggregate protection on the entire group. So the reason that we feel comfortable setting up self-funded plans is because when we implement a plan for an employer that's coming from a fully insured plan, we will make sure that their self-funded exposure is no greater than their fully insured premium cost. So if they have a terrible year on their self-funded plan, the worst case scenario is that they would meet or equal the premium that their fully insured plan would cost. And the benefit of the self-funded plan is if your group runs well and you have healthy employees and you implement some wellness initiatives and make sure that your employees are focused on healthy living and healthy lifestyles, then you have a much greater chance of having an annual cost that is significantly lower than what your fully insured premium would cost. So that's the reason that larger employers and even mid-sized employers are now considering self-funding, because they're no longer responsible for that set fixed monthly payment to the fully insured carrier. They get the same coverage as they do on a fully insured plan. Their employees don't see a difference in their benefits, and if the employees run well from a utilization standpoint, then the employer stands a much greater chance of saving a significant amount of money over that year with their health insurance plan. So in closing, we'd like to thank you for joining us today and listening to our webinar regarding the benefits of self-funding your employee benefit plan. We're always available to answer questions. You can reach us at 631-283-8000, and my extension is 368. Again, Will Hussey with Marin Corporate Risk Associates. And again, thank you for joining us today. We hope you learned something, and we're always available to answer questions in the future. Thank you.